This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Time to answer those questions again. Thank you so much for all of them. We've gotten a bunch, and I really appreciate them. And I will try to give you the best answers I can. And if you want to ask some, go to talkingrealmoney.com, click on the Contact Us button there, and then speak your question in using a microphone on your phone, your tablet, your computer, whatever it might be. The better the quality of the mic, the better your questions sound. And given the fact that we're using our computers and the computer parts of our phones more and more for communication, good mics matter. Now, the phones have some pretty darn good mics. It's funny, computers generally don't. The exception probably is the MacBook Pros. But your iPhone, for example, has great microphones. They're really terrific. So ask your questions, and I will give you some answers as I am able, and I really appreciate you being a part of it. Also, you can call us on Saturdays when we do a show, both of us, Tom and me. And that number is 855-935-TALK, and you need to call us between 3 p.m. and 5 p.m. Eastern Time on Saturdays. Now, let's get to today's first of 5, I believe. Yes, 5 questions.
Hey guys, this is Matt from Utah. I just want to say thank you for your podcast. It's my favorite, and I listen to quite a few. So thanks for all the great work you guys do. Got a question. You guys have been recommending DAFW, the Dimensional All World Equity Fund, as well as AVGE. And in looking at those compared to VT, I've noticed, especially with the Dimensional Fund, some days it has a huge bid-ask spread, if I'm understanding that correctly. And it seems like investors should be cautious about that bid-ask spread and could lose a lot of money on it if they did not set a limit order instead of a market order on that. And with bigger funds like VT, of course, and VTI and VXUS, of course, the bid-ask spread is minute, so it's just pennies and you're not really losing anything. But on those newer ETFs that Avantis has put out and Dimensional has put out, I noticed the bid-ask spreads are huge and could be really detrimental, I would think. And I personally am a little old school. I like the index mutual funds, especially for tax-advantaged accounts, just because you get the price at the end of the day instead of messing with the bid-ask spread. I understand the reason why it's important in a taxable account to use ETFs. But I just wanted to pick your brain a little bit about that, make sure I'm understanding that correctly, and ask you to explain that to us as listeners. Thanks so much. Bye-bye.
Okay. DFAW, the spread is not huge. Yes, the spread is definitely larger than the spread for a VT, something that really, really trades a lot, because DFAW trades about 40,000 shares a day or something like that, whereas VT, let me just look. I didn't look at VT, but I should. VT, Total World Stock Index, it trades like 900,000 or a million shares, and its spread is 2 basis points. But the difference, consider I'm only going to pay that spread once. It's not part of my ongoing expenses because I'm going to hold it for probably many, many years, if not decades. So that expense gets amortized out over a long period of time. However, the 11 cents isn't exactly what you're going to pay. I decided just to test it. I had some cash in my Schwab account, and I thought, I'm going to buy some DFAW because I was going to buy some anyway. And I want to buy it whenever I want to buy it. I want to buy it. I don't really care what the price is. I'm not going to quibble about the price. I'm not going to go, okay, well, gee, it's $62 today. I may want it at $61, and then wait, but I could wait forever for that to fill. And that's the problem with a limit order, is that a limit order can keep you from filling. If the stock is moving against you, it's rising, well, your limit could keep you from buying it, and I want to own it. So I just wanted to test it, though, and see what it looked like. So I put in an order to buy DFAW at the market. And at the moment I placed the order, the spread was $62.19 bid, $62.30 ask. That means somebody has put in an order. They say, I want $62.30 for my shares, or I'm not selling them. Somebody else said, I only want to pay $62.19 or I'm not going to buy them. So what do you think happened? This is what happens most of the time, but I wanted to get the exact number and make sure it happened the way I remember it usually happening. I placed my order, and it executed at $62.25. Wow. That's exactly halfway between the two. That's because here's what happened. Another market sell order came through the same time as my market buy order, and that's normal. Most orders come through not with limits, but with just a market. So it came through. Schwab split the difference. They gave that person half the distance between the high and the low, and they gave me half. So I ended up with a really good price that was like 8 basis points above the bid price. To me, that's just not enough to quibble. I'm not a big fan of limit orders. It's a market timing thing almost. We're quibbling over almost nothing. But thanks for the question. Thanks for the nice comments. And let's do the next one.
Hi, Tom and John. This is Jason from Everett, Washington. I have a question about very short-term investment. So I have taken out a HELOC. In order for me to get a 10 basis point discount on my HELOC, I need to take more money than I needed to. So I have $40,000 that I need to pay back in about 90 days. Can't really pay it off before that. So I want to invest, or I guess save for 90 days and get the maximum amount of interest. So I went to my Fidelity account, and there are a zillion different CDs and bond funds and other things that are on offer. And I see coupon rates at 4.35, 4.3, 4.25, and then bond rates at various amounts. I just have no idea how to think about this. Like, what's the smartest way for me to just throw $40,000 into an account for 90 days and make back a little bit of cash that I can then put back in this interest? Because it's very confusing. So I hope you can help me. Thank you.
Yeah, like everything else, you got to figure out which trade-off is worth taking, because there are going to be trade-offs. Give you an example. The highest rate you can get right now on high-yield savings is about 4.5. I think I found one from Bankrate that was 4.58 from these little tiny internet banks. But they're all FDIC insured, so who cares? However, what's the risk of that? Well, the rate could change. If rates go down, that rate could fall, and maybe you're only getting 4 or 3.75, heaven forbid, although over 90 days, that's not very likely. So that's one way. That's really safe in terms of getting your principal back. There might be some fluctuation in interest. You could go with a short-term bond fund. That's pretty stable, going to get you about 4 point, depending on the quality. The higher quality stuff is going to get you about 4.2, somewhere in there. But you could have some fluctuation in the value. The only one that gives you an absolute term, absolute return is a 3-month CD. Now, you could probably buy a 3-month CD right now from Schwab for 4.3%, a yield of 4.3% to maturity. And that will be there. That rate won't change. And you know that your money is FDIC insured, so it won't fluctuate like the bond fund will. So you're going to be somewhere in that low 4 range, no matter what you do, with a reasonably high degree of safety. So I guess it comes down to what you're most comfortable doing. I would probably just take the 4.3% CD because it matures in 90 days, and it's a nice reminder to quick pay off that HELOC or pay off that extra money on that HELOC. So that would be my choice. You can get one of those in the secondary market from Fidelity, maybe as much as 4.4. It depends on the timing. Good luck. Thanks for the question. Remember, send your questions in at talkingrealmoney.com. Use the Contact Us button or call us on Saturdays at 855-935-TALK. Next question.
Hi, Don. If for whatever reason we should happen to go into a recession, do you think my emergency fund is better in VMFXX, the Vanguard Federal Money Market Fund, or VUSXX, the Vanguard Treasury Money Market Fund? There's another one here, VMRXX, Vanguard Cash Reserves. So which of those three would you recommend? Thank you.
We're doing a lot of quibbling over little teeny, tiny margins here. I mean, tiny. Holy mackerel. I think we overthink. You think? Yeah, I think. I think we overthink. Do you think we overthink? I think we do. Anyway, what are these three funds? Well, the VMR, the VMR XX, yeah, the VMR XX, which was the last one, is the Vanguard Cash Reserve Federal Money Market Fund Admiral shares. What does that mean? Well, that means that it is invested in full faith and credit securities of the U.S. government, but not necessarily direct obligations of the government. You can have some federal home loan notes and things like that in there. So let's, the security of it is high, but is it as high as VUSXX, which is the Treasury Money Market Fund? Well, the Treasury Money Market Fund is in full faith and credit instruments of the U.S. government. So if we're quibbling over minutia, yeah, it's a little bit safer. And then let's go back to that very first one, which was VMFXX, which is the Vanguard Federal Money Market Investor. It's very similar to VMRXX, similar in that it's federal obligations, but not directly backed by the full faith and credit of the, well, it is. Oh my gosh, we're just squibbling over tiny little differences in risk. Of these three, the VMR XX is probably the slightly most aggressive, and it also has the slightly higher yield of 4.95. The second is VMFXX. It's 4.93. And the safest is probably VUSXX, and it's also 4.95. The reason it's 4.95, even though it's a little bit safer, is because it's so cheap to run, because all they do is buy Treasury securities, Treasury bills. So their expense ratio is lower, allowing them to give more money to you. So if I had to pick between the three, VMFXX. That's what I'm going for. Final answer. Okay? But any one of the three, just absolutely fine. Oh, and by the way, for the previous questioner, that would also be an option for you for your money. And that's a little higher yield than bank CDs. And yet it still has that risk that the rate could change day to day to day to day. So your rate could be lower, higher tomorrow, depending on what interest rates do. Okay, now let's do another one, shall we?
I thought from the header that they were talking about social insecurity and that it might be related to the new politics and getting into the accounts and changing anything for less benefits. I didn't see any answer to or even relevant information in the little podcast you were doing.
Well, I assume by the header, you mean the title of the podcast that was Social Insecurity from a couple of weeks ago. If you're looking for political discussion from us, you're looking in the wrong place. Tom and I really do abhor getting into the politics of all the financial issues, although we will sort of dance around the edges because politics does sort of impact us, but actually the evidence is that it really doesn't impact us long term. No, what we were talking about was some comments by former Social Security officials that the system for making timely payments and doing it without error is in danger because of the budget cut. So we addressed that, and we also addressed the whole idea of whether you should worry about it, which we think you shouldn't, and when you should take benefits, which generally speaking is later than sooner, but you've got to adjust that to your own personal situation. So I think that was the gist of what we talked about. But no, we're not going to get into the political future of it, except to say it's too dangerous for Congress to allow the program to be changed dramatically. It's just politically rife with issues. I cannot imagine any party doing that. I mean, the Democrats have come out and said, absolutely no way, not touching it. In fact, some of them, like Bernie Sanders recently said, more money. We want more money to recipients. But I just don't imagine anybody wanting to, well, anybody. Again, I'm going to try and avoid politics. It's so hard when you have idiots spouting off about it. Like it being a Ponzi scheme. Jeez. Okay. No, I honestly think that we will find ways to fund it. We've run into problems before. We've changed when you can take benefits, and that may change. The taxation may change. I think it's silly. I make more than 170 whatever thousand a year. I'm very lucky. I'm very blessed right now in my life. I've never made as much these days as I make now. I am, but I don't make a lot more than that. But I make more than that. And it never made sense to me that suddenly my income stopped being taxed for Social Security. I can afford it. I would think so can anybody who makes over 172 or 3 or 5,000 a year. But nobody likes paying taxes. But should we? Yeah, probably. Anyway, thank you so much for whatever that was. And let's grab our last question of the day.
Hello, Tom and Don. This is Brenda from Wisconsin. Thank you for all you do. I am 62 and due to health issues, need to stop working. Due to financial reasons, I will be collecting Social Security immediately. My Social Security payment will pay for my basic needs. I currently have $70,000 in a traditional IRA. That is all of my retirement money. I want to start withdrawing $700 a month from my $70,000 IRA at age 64. I would like the money to last until age 75. I took your risk quiz and scored a 37. As you can imagine, I would hate to lose my $70,000. How would you recommend that I invest the $70,000? Again, thank you for all you do.
You're welcome. You are right on the brink of a dilemma. On the brink, but you actually should be able to pull off what you plan to do given your parameters. If you said you wanted $700 a month for the rest of your life, I would say cannot be done. Period. Cannot be done with $70,000. You can't do $700 a month. But if you do it starting at age 64, 2 years from now, and you invest it conservatively, very conservatively in my opinion, you can probably pull this off, but only by literally the hair of your chinny chin chin. As the wolf said that. I was trying to remember if it was the wolf or the pigs. It was the wolf. Oh, wait, no, it was the pigs. Yeah, it was the pigs, not by the hair of my chin. Yeah, I think so. Gosh, I can't remember my 3 pigs. Anyway, back to the question at hand. If you invest it at about 4%, tiny bit over 4% for the next 2 years, you should now see your nest egg grow to about $76,000. Then you take that and you invest it in, assuming interest rates are about where they are today, you buy a 5-year CD ladder. I want to keep you from any kind of volatility at all. You buy a 5-year CD ladder through a brokerage firm like Schwab or Fidelity or whomever, and you have to keep the discipline. If you can't keep the discipline, you're going to have a problem. But this is one of the options. You should be able to take out $700 a month for the next 11 years and end up with about $2,000 left. That's why I was talking about you're kind of close. You might want to consider, I think this might be a little easier for you, using something like the Vanguard Total Bond Index Fund, which is still very safe. But it does at times lose value, but it has recovered that value historically. So you would probably be okay. And under this scenario, if rates stay the way they are, you are definitely okay. However, all bets are off if rates go down on the CD scenario. If rates start dropping precipitously, it's not going to last. And that's where it gets tricky. And that's where we start suggesting that even those who have little money consider having a portion, 10%, in a really well-diversified stock mutual fund or ETF, like the DFAW we talked about earlier, or VT, which we talked about earlier, something like that. Just a tiny bit. But your risk quiz says you're very, very conservative. So that's why I come back to the bond fund or the CD ladder, but there's always going to be some sort of a risk. There cannot be any certainties about that nebulous thing out there called the future, but you're close. You're going to need to still be a little flexible if things don't go perfectly, but right now, you look like you're in good shape, just barely. Thanks so much for your question. Thank you all for your questions and comments and all the nice stuff you say about us and the nice reviews you give us, some of you, except for the crypto fiends. If you want to, go to Apple Podcasts and leave a positive review to offset the negatives. But still, overall, we have very positive reviews. And if you like what you hear, tell a friend or two. And if you want to, call us on Saturdays between 3 and 5 Eastern if you'd like to talk with one of us or both of us, 855-935-TALK, or go to talkingrealmoney.com to leave your questions. Take good care of yourselves. Talk to you soon. And when we do, guess what we're going to be talking about? You guessed it. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.